Join me as I walk you through all my latest stock moves, revealing the companies I've been adding, buying more of and selling. And in today's video, we'll go through 6 stocks in total, 3 new positions, 1 I've been adding more to, and 2 that I've been trimming. Now, if you'd like a deep dive into the rest of my portfolio, feel free to check out my channel as well. And let's start off with one of my new stocks, beginning with Pinterest. Today, I've given the company a portfolio weight of 3%. That's how much of my portfolio that's allocated towards Pinterest stock. Now, in my latest analysis, I gave the company 4 out of 5 stars as my final rating, and today Pinterest has a market cap of roughly 22 billion and the stock has increased by roughly 5% year to date. And if we take a closer look at Pinterest stock chart year to date, we can see that the stock was actually up by 30% at one point this year. Now since then the stock has corrected, it's down 20% from those highs earlier this year. So I thought might as well invest in a company that I'm bullish around and I also believe is undervalued right now. Now, in my opinion, Pinterest isn't built around chasing likes or viral content. Instead, it's a visual discovery engine where users come to plan, dream and shop. Today, Pinterest has over 500 million active users with strong international growth. And financially, it's steadily expanding margins while growing revenue in the mid-teens. Now, I've also noticed that investor sentiment has improved as ad spending rebounds, and this to me signals stronger monetization potential ahead. So I thought might as well pull the trigger on Pinterest stock. Now let's take a closer look at the summary of my evaluation of Pinterest that I went through in my previous video just a few weeks ago. And my fair share price has come in at roughly $48.6. Now this implies that the stock could be undervalued by 34% and that investors could potentially get 20% annual returns going forward in the next 10 years. Now keep in mind that Pinterest isn't like, for instance, a Microsoft where you have strong recurring revenues. This is much more like a Google, right, where the company relies on ad sales. Now that's a higher risk, but I believe that risk is already baked into the current valuation of Pinterest. Now finally, let's take a look at how Pinterest compares to other stocks that I've covered on my channel. Now here you can see a investment positioning landscape where you have the undervalued stocks at the top and also the great businesses to the right. So you want stocks that are up to the right. Now I'd actually place Pinterest over here, right? Definitely undervalued according to my bullish assumptions, worthy an investment in my opinion if you believe in the long-term potential of the company. Okay, so let's move on to the second stock that I've been adding to my portfolio, which is Edwards Lifesciences, and this is a stock that I've also covered in a separate video just a few weeks ago. Now I've given Edwards a portfolio weight of 2.2%, which is slightly lower than Pinterest. However, I've given the company a slightly higher rating of 4.5 stars. And today Edwards has a market cap of 45 billion and the stock has returned roughly 6% year to date. Now, if we take a closer look at Edwards stock chart year to date, we can see that the stock was at one point up by 13% year to date. Now, since then, the stock has had a slight dip, right? It's been down by close to 10% in recent weeks. Now, this is when I doubled my initial position from 1% to 2.2%, as I believe in the long-term opportunity of the company, and the stock is, in my opinion, quite reasonably priced at the moment. Now, Edwards is a healthcare company laser focused on structural heart disease, and Edwards products stand out as a non-invasive solution that offer patients faster recovery, less pain, and a life-changing alternative to open heart surgery. Now, recent optimism in the medical device sector have lifted sentiment, and the company's guidance for 2025 also points to accelerating growth, reinforcing my conviction around the stock long term. And let's take a quick look at my most recent valuation estimates for Edwards. And my updated fair share price lies at around $85. Now, this implies a slight discount of around 10%. However, this also implies an annual return of around 19% in the coming 10 years, which I believe is attractive for this type of company. Now, if we compare Edwards to other stocks that I've covered and also invested in, and I would actually place Edwards around here, right? This is a great business in my opinion, one of the best healthcare stocks I've ever come across. However, it's not really that deeply undervalued right now. A 10% discount isn't really that amazing, especially if we compare with, for instance, Pinterest, which has a much higher discount according to my bullish estimates. Okay, so let's move on to the third stock in this video and the final of the new stocks in my portfolio, and this is Figma, a recent IPO that has fallen by over 40% in recent weeks. Now, I've given Figma a slightly lower portfolio weight of 2% compared to Pinterest and Edwards. However, I've still given the company a 4-star rating. This is slightly higher than in my recent valuation video, as the valuation of Figma has become much more attractive as the stock has fallen. Now, Now the company still has a 29 billion market cap. However, the year-to-date return has been negative 50%. Now if we take a closer look at Figma's year-to-date stock chart, we can see that the stock has been all over the place. We can see for instance that it peaked just after the IPO at around $122, and since then it actually cratered but close to 60%. Now at that time that was actually lower than my valuation estimates. I took that opportunity and added just a small position. Now the good news is that it has slightly recovered, right? It's up by 40%. We'll see how long that lasts. I wouldn't be surprised if Figma stock would fall down to the 50s again if the overall market decides to go down as well. Now as an example of how volatile this stock is, we can see that it's for instance up by 13% only today as of this recording, so you really don't know where this stock might be in the short term. Now in my opinion, Figma is transforming how teams design and collaborate in real time, a strength that competitors like Canva and Adobe can't really replicate. And despite its post-IPO volatility, adoption among enterprise clients is growing strong, and with the stock trading well below its highs, it felt like an attractive long-term entry point just a few days ago. Now let's take a look at my most recent valuation estimates for Figma. Now the current share price is around $59 excluding the big jump of today, and my fair share price is the same as in my last valuation video for Figma at around $52. Now this means that the stock is once again trading at this slight premium. However, the annual return is around 18% still. To me as an investor is quite attractive, right? Getting 18% annual returns is definitely beating the market long term. Now since my last Figma valuation video, the company actually reported its first quarterly earnings, and in that report growth was slightly disappointing in my opinion. However, on the positive side, the adjusted operating cash flow margin was 24%, and that's above the 22% that I had forecasted previously, and that's why my fair value estimate remains unchanged at around $52 per share. Now, if we take a closer look and see how Figma compares to other stocks that I've discussed on my channel, I'd actually place the stock over here, right? At the time that I invested in the stock at around $50, it was slightly undervalued in my opinion, and it's also a great business as well. So I thought might as well pull the trigger and start a small position in the company. Okay, so let's move on to the fourth stock of this video, and this isn't a new stock, but it's a stock that I've increased my position in the past few months, and that stock is Uber. And today I've given the company a 4.2% portfolio weight. Now I've also given the company 5 out of 5 stars as my final rating, and today the company has a market cap of around $210 billion, and the most impressive stat is that the stock is up by around 60% year to date. Now if we take a closer look at Uber's year to date stock chart, we can see that this stock has been a beast. It has been just up and up and up. We can see that the stock is actually quite close to its all-time highs. It's just below by roughly 2%. Now my increased investments in Uber were in the beginning of the year when the stock was slightly more attractive, right, in terms of price, so I wouldn't really add that much more to my Uber position today. But if the broader market declines and Uber stock also does, then I would also think about increasing my position. And Uber was actually once seen as a cash burning disruptor. Now Uber has become a consistently profitable platform with strong free cash flow, and if you add to that strong geographic dominance, you have a serious competitive moat. Now if we take a closer look around my latest valuation assumptions for Uber, we can see that the current share price is around $100. However, my fair share price is still above that at around $126. Now this also implies that the stock is trading at a 20% discount, and that we as investors could potentially get 16% annual return going forward in the coming 10 years. Now if we take a closer look and see where Uber stock lies compared to other stocks that I've been analyzing, and actually place Uber around here, right? This is definitely an undervalued company in my opinion, and this is also why a few months ago I made a video and named Uber my stock pick of 2025. I really believe that this stock can really turn around, deliver growth, and also increase profitability in the coming 10 years. Okay, so let's move on to the fifth stock in this video, and this will be slightly less positive as this is one of the stocks that I've been reducing, and that is Chipotle Mexican Grill. Currently the stock has a portfolio weight of just 2.1%, and I've given the company 3.5 stars as my final rating. Now today the company has a market cap of $56 billion, and the worst that is that the stock is down by 30% year to date. And if we take a closer look at the year-to-date stock chart for Chipotle Mexican Grill, we can see it has been quite negative throughout the full year right now. This is due to Wall Street, of course, losing confidence in Chipotle's ability to continue to grow at the same pace and also expand margins. Now, Chipotle is one of the most successful fast casual restaurant chains in the US, known for its customizable burritos, bowls, and tacos. Now, with softer consumer spending trends and rising food costs, I decided basically just to lock in a few profits and reallocate towards higher upside opportunities like Pinterest, like Figma, or Edwards, for instance. Now, if we take a closer look at my most recent valuation assumptions for Chipotle, I've given the company a fair share price of around $37 US. Now, this implies that the stock is trading at a slight premium of 13%. However, I still believe that the stock could give annual returns at around 17% in the coming 10 years. Now, if we compare Chipotle to other stocks in my investment positioning landscape, I'd actually place the stock over here, right? However, if growth would re-accelerate, then it would move upright to the undervalued section again, and then I would actually consider increasing my position in Chipotle again to roughly 3 or 4%. Okay, so let's move on to the final stock in this video that I've also been reducing over the past few months, and that is Universal Music Group. Today, the stock has a weight in my portfolio of 4.1%, and I've given the company 4 out of 5 stars. The company has a market cap of 45 billion euros, and the stock has been basically flat year to date. And taking a closer look at Universal stock chart year to date, we can see that the stock was at one point up by 20%. Now, since then, it actually fell by 20%, and since that price, the stock has been basically flat throughout the year. And this one really pains my heart, because UMG is one of the best businesses I've ever come across. UMG owns rights to over 30% of global recorded music. It's an incredible business model built on timeless assets, and thanks to streaming, the music business has become a recurring revenue machine. Now, the underperformance of the stock is partly due to concerns about slower streaming growth. However, I still believe in the long-term story, but decided to trim my position just to manage risk. Now, taking a closer look at my most recent valuation assumptions for Universal Music Group, I have a fair share price at around 31 euros. Now, this implies that the stock is trading at a 21% discount, and that we as investors could potentially get 17% annual returns from the stock in the coming 10 years. Now, comparing UMG to other stocks, I'd actually place the stock over here, right? This is one of the best companies I've ever come across, and the stock is, in my opinion, undervalued today. However, due to Wall Street and institutional investors slightly losing confidence in the stock, I've had to trim my position in recent months. So yeah, we reached the end of the video. Here you can see a summary of my entire portfolio and the stocks that I've been adding to and the stocks that I've been reducing. And if you'd like to see the in-depth analysis of some of these companies, feel free to check out my channel. You'll find those videos easily there. So yeah, see you in the next one.